There is a final promise that separates the masters from the masses. It's an oath taken not in a boardroom, but in the quiet solitude of one's own mind. It's a promise not of spectacular, lightning-in-a-bottle genius, but of a profound and disciplined humility. This promise is the bedrock upon which the greatest fortunes of the modern age have been built, and yet it remains the most violated principle in the entire landscape of finance, business, and personal achievement. The man who has lived this promise more faithfully than any other is Warren Buffett, and the promise is this: you will not venture into the territory you do not understand. You will honor the boundaries of your own knowledge. You will accept that in the world of investing, you get no extra points for difficulty. In fact, you are penalized for it. This is the story of Buffett's most powerful, yet most deceptively simple tool, the too hard pile. It's not a complex algorithm or a secret formula. It's a mental framework, a discipline of refusal, that has saved him from more financial catastrophes than any brilliant insight has ever earned him. We live in a world that worships complexity. We believe that a problem solved with a convoluted equation is more impressive than one solved with common sense. We assume a business strategy articulated with dense jargon and acronyms must be superior to one that can be explained on the back of a napkin. This bias, this deep-seated belief that difficulty equals value, is the single most destructive force for the average investor, the aspiring entrepreneur, the retail investor trying to secure a future. It is the siren song of Wall Street, luring you onto the rocks of risks you can't see and financial instruments you don't comprehend. The cost of this mistake is not just a few percentage points of return, it is the catastrophic loss that sets you back decades. It's the stress, the anxiety, the sleepless nights spent worrying about a position that you never truly understood in the first place. The financial transformation that comes from embracing Buffett's principle is not just about money, it's about clarity. It's about trading a portfolio of anxious questions for a portfolio of confident answers. It's about developing a profound bias for simplicity, focusing your time, your capital, and your precious mental energy only on the things you can understand deeply. This isn't about being lazy, it's about being lethal. It's about recognizing that your cognitive focus is your most valuable asset and refusing to waste it on puzzles that don't need to be solved. By the end of our journey today, you will possess the blueprint for this system. You will learn how to define the borders of your knowledge, how to resist the seductive allure of the complex, how to build a mechanism for saying no, and how this simple act of intellectual honesty becomes the ultimate competitive advantage, leading to superior long-term results and a state of stress-free investing that few ever achieve. This is the key to building not just a portfolio but a fortress of financial security you can manage with confidence and unshakable clarity. This is the final promise. The entire architecture of Warren Buffett's investing philosophy, the Grand Cathedral of Berkshire Hathaway, is built upon a single, unadorned cornerstone. It's a concept so simple that it's often dismissed by those seeking a secret, complex formula for wealth. This cornerstone is the circle of competence. It is the absolute foundation of simplicity, the intellectual starting point for every great investment decision he has ever made. It's an idea that he and his partner, Charlie Munger, have preached for over 50 years with the fervor of evangelists. The principle is this: every individual, through their experiences, their career, their studies, has built up pockets of specialized knowledge. Inside this circle are the businesses and industries you understand intimately. Outside of it lies everything else. The task of the intelligent investor is not to have a circle that encompasses the entire universe of business. The task is to define, with brutal honesty, where the perimeter of your circle lies, and then to operate entirely within it. The size of the circle is not what's important. The knowledge of its boundaries is vital. This is the source code for the too hard pile. Before you can decide what is too hard, you must first define what is easy for you. Perhaps no story illustrates the power of this foundational principle better than the acquisition of See's Candies in 1972. At the time, Buffett and Munger were managing a partnership, and they were presented with an opportunity to buy a well-known, family-owned candy company based in California. On the surface, it seemed almost comically unsophisticated. This was the era of the Nifty 50 stocks, the darlings of Wall Street, companies like IBM, Xerox, and Polaroid. These were businesses of the future, built on technology and complex patents. Analysts were building intricate models to project their growth to the moon. And here were Buffett and Munger, looking at a business that made chocolate lollipops and peanut brittle. See's Candies was the epitome of a simple business. It purchased raw materials like sugar, chocolate, and nuts. It followed recipes that hadn't changed in decades. It employed people to make and sell the candy in its own retail stores, primarily on the West Coast. There were no complex technological risks, no threat of foreign competition with a cheaper microchip, no arcane accounting that required a doctorate to decipher. You could walk into a store, see the product, talk to the customers, and understand the entire business model in under 5 minutes. The founding See family wanted to sell the company for $30 million. Buffett and Munger, after their analysis, determined it was worth $25 million. A $5 million gap. For many deal makers, this would be the end of the conversation. But because the business was so simple, so squarely inside their circle of competence, they could see something the spreadsheets didn't capture. They understood the economics of a brand. They saw the fanaticism of the customers. They recognized that See's wasn't just selling candy, it was selling nostalgia, tradition, and a feeling of affordable luxury. This gave it a powerful, unwritten asset: pricing power. Each year, the company could raise its prices just a little bit to cover inflation and then some, and the customers wouldn't flee. They would happily pay, because the box of See's was a non-negotiable part of Christmas, Valentine's Day, or a birthday. This simple insight, this understanding of consumer psychology applied to a simple product, was the key. They eventually negotiated and bought the company for their price of $25 million. That single investment has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, money that was then reinvested into other simple, wonderful businesses. It was, as Buffett would later call it, the prototype. It taught them that the most profound competitive advantages, the deepest moats, are often found in the simplest of enterprises. They didn't need to understand semiconductor physics. They needed to understand why a person in California would pay a premium for a specific box of chocolates. That was inside their circle. That was enough. The psychological principle that Buffett's circle of competence so brilliantly overrides is one of the most pervasive and dangerous cognitive biases in human decision-making, the Dunning-Kruger effect. Coined by two social psychologists, David Dunning and Justin Kruger, this effect describes a phenomenon where individuals with low ability or knowledge in a particular domain tend to vastly overestimate their competence. In essence, they are too ignorant to recognize their own ignorance. We see this everywhere. The amateur musician who thinks they're ready for a record deal, the weekend warrior who believes they could compete with professional athletes, and most destructively, the beginner investor who, after a few lucky trades in a bull market, believes they have cracked the code of Wall Street. This overconfidence leads them to venture far outside any area of genuine understanding. They hear about a biotech company with a promising new drug pipeline, and despite having no medical or scientific background, they convince themselves they can evaluate its chances of FDA approval. They read an article about a disruptive fintech company, and, with no experience in software or banking, they pour their savings into it. They are operating under the illusion of knowledge, mistaking familiarity with a ticker symbol for a deep understanding of a business model. Buffett's framework is a deliberate and systematic antidote to this poison of overconfidence. The first rule of the circle of competence is not know everything, it's know your own limits. It forces an investor to perform an act of radical humility. It requires you to look in the mirror and say, I do not understand the economics of 5G technology. Or, I cannot predict the long-term competitive landscape for social media platforms. This act of self-assessment is the wall that protects your capital from your own ego. By consciously drawing the boundaries, you are disarming the Dunning-Kruger effect before it can do any damage. You are making a pre-commitment to intellectual honesty. You are admitting that the world is filled with subjects too complex for you to master, and that is perfectly okay. This isn't a sign of weakness. It's the hallmark of professional-grade decision-making. The amateur wants to play every hand. The professional waits for the one they know they can win. So how do you translate this theory into a practical, applied mental model? How do you build and maintain your own circle of competence? This is the blueprint, the step-by-step process for making this powerful concept a part of your own investing and decision-making DNA. The first step is to conduct a rigorous self-audit. This isn't a 5-minute exercise. This requires deep, honest reflection. Get out a piece of paper or open a document. Create 2 columns, I understand and I do not understand. Now populate them. Think about your career. If you've worked in insurance for 20 years, you likely have a deep, intuitive grasp of how insurance companies make money, how they assess risk, and what makes one better than another. That goes in the first column. Think about your hobbies. Are you a passionate gamer who understands the business models of video game companies? Are you a car enthusiast who knows the automotive industry inside and out? Think about your daily life. You are a consumer of products every single day. Which of those products come from businesses whose operations you truly understand? Coca-Cola, Procter & Gamble, McDonald's? These are often starting points for many people. Be brutally honest in the second column. If you can't explain it, it goes there. Biotechnology, semiconductor design, complex banking derivatives. For most people, these belong in the I do not understand column. The second step is to apply the explain it to a child test. This is a powerful filter popularized by physicist Richard Feynman. If you truly understand a concept, you should be able to explain it in simple terms to an intelligent 10-year-old. Take a company you think is in your circle. Can you explain how it makes money, who its customers are, what its durable competitive advantage is, and why people will still be buying its product in 10 years, all in under 2 minutes, using simple language? If you find yourself resorting to jargon, buzzwords, or convoluted explanations, that's a red flag. It's a sign that your understanding is superficial. The business must be moved to the edge of your circle, or perhaps outside of it entirely, pending further study. Third, you must map the boundaries explicitly. Don't leave it as a vague concept in your head. Write it down. Your statement might look something like this. My circle of competence includes consumer packaged goods companies with strong brands, well-run regional banks, and property and casualty insurers. It does not include technology companies dependent on future innovation, pharmaceutical companies, or commodity producers like oil and gas firms. This written declaration acts as your constitution. When a tempting idea from outside your circle comes along, you can refer back to your own rules. This creates a powerful barrier against impulsive decisions. Finally, understand that the circle is not static. You can, and should, work to slowly and deliberately expand it over time. But this expansion is not done by chasing hot tips. It's done through deep, focused study. If you want to understand the railroad industry, you don't just buy a railroad stock. You spend a year reading every book on the subject, studying the annual reports of every major railroad for the last decade, and learning the key metrics of the industry. You expand your circle brick by brick, through genuine learning, not through speculation. This patient process of mastery ensures that when you do step into a new area, you do so with the same level of confidence you have in your core domain. Now let's explore the antithesis, the path walked by the 99% of investors who ignore this fundamental wisdom. This is the path of the jack of all trades, master of none investor. Their portfolio is a chaotic reflection of the last 3 months of financial news headlines. One week they're buying a cannabis stock because they read an article about legalization. They don't understand the agricultural economics, the regulatory landscape, or the competitive dynamics. They just know it's a hot sector. A month later, they've sold that at a loss and are chasing a company related to cryptocurrency without understanding blockchain technology or the difference between a utility token and a security. Then, a biotech firm announces promising trial results for a new drug, and they jump on that, without any ability to read the clinical data or assess the probability of its success. This investor is perpetually dancing on the perimeter of 1,000 circles of competence, but never setting foot inside one. They are a tourist in the world of business, never a resident. The dot-com bubble of the late 1990s is the ultimate case study in the catastrophic failure of this approach. Millions of retail investors, emboldened by a soaring market, abandoned all pretense of understanding. They poured their life savings into companies with .com in their name, believing that the old rules of business no longer applied. They bought companies like Pets.com, a business that was, in essence, buying bags of dog food for $10 and selling them for $8 after accounting for marketing and shipping costs. The business model was fundamentally broken, a simple truth obscured by the complex narrative of e-commerce disruption and capturing eyeballs. But because the stock price was going up, because it was a tech company, and because they felt they had to be involved in the new economy, they ignored the obvious. They were operating so far outside their circle of competence that they couldn't even see the cliff they were sprinting towards. When the bubble burst, fortunes were annihilated, and the simple, boring businesses, the candy companies, the beverage makers, the insurers, were the ones that survived and thrived. The 99% learned a brutal lesson. Investing in what you don't understand is not investing. It's gambling, and the house always wins. The direct financial connection between staying within your circle of competence and your bottom line is profound and multifaceted. First and foremost, it drastically lowers your mistake rate. Investing is a game of avoiding unforced errors. When you truly understand a business, you have a much higher probability of accurately assessing its intrinsic value. You can read the balance sheet of a company like Hershey's and understand what the inventory, accounts receivable, and goodwill actually represent in the real world. You can look at their income statement and understand the stability of their gross margins, because you understand their pricing power over cocoa and sugar. For a complex semiconductor company, the line items on their financial statements might be abstract concepts to you, like capitalized research and development or patent amortization. This deep understanding allows you to buy with a greater margin of safety, the famous principle of Benjamin Graham. You are less likely to overpay, and you are less likely to be blindsided by a problem that would have been obvious to an industry expert. This single factor, the avoidance of catastrophic losses from buying businesses you don't understand, is arguably the most important variable in long-term wealth creation. One or two major blow-ups can wipe out the gains from a dozen good decisions. The circle of competence is your primary defense against those blow-ups, ensuring that your wealth management strategy is built on a foundation of rock, not sand. This is the first step toward true financial education, the realization that what you don't do is just as important as what you do. The world whispers a dangerous lie into the ear of every investor and entrepreneur. The more complex the idea, the greater the reward. We are conditioned to believe that brilliance is shrouded in jargon, and that simple solutions are for simple minds. This allure of complexity is a gravitational force, pulling us towards investments and strategies that feel sophisticated, exclusive, and intellectually impressive. It is the siren call that promises a secret knowledge, a shortcut to beating the market accessible only to those who can decipher the code. But Warren Buffett's career is a 50-year testament to the opposite truth. This allure is a trap. Resisting it is not a sign of a simple mind, but of a disciplined one. Deconstructing why we are so drawn to the difficult is the key to building the mental fortitude required to stay on the simple path to financial freedom. No period in Buffett's life tested this discipline more than the dot-com bubble of the late 1990s. The world was changing at a dizzying pace. The internet was reshaping commerce, communication, and culture. A new breed of technology company, promising exponential growth and a new economic paradigm, dominated the stock market. Companies like Cisco, Intel, and Microsoft were the new royalty of Wall Street, and their stock prices seemed to defy gravity. During this frenzy, Berkshire Hathaway was a dinosaur. Buffett was sticking to his knitting, buying brick-and-mortar businesses, insurers, and consumer brands. As tech stocks soared, Berkshire's stock began to lag the market, and the whispers turned into a roar of criticism. The financial press, once fawning, turned on him. The most famous rebuke came in late 1999, when the influential magazine Barron's ran a cover story with the headline, "What's Wrong, Warren?" The article portrayed him as a relic, a man whose folksy, value-based approach was hopelessly out of touch with the new digital economy. The social and professional pressure was immense. His own shareholders were questioning him. His peers were getting fabulously rich, on paper, by buying anything with a .com suffix. It would have been the easiest thing in the world for him to capitulate, to make a token investment in a few big-name tech stocks, just to quiet the critics and get back in the game. But he refused. His reasoning when asked was maddeningly simple. He would say, "I don't know how to value them." He couldn't look at a company like Cisco Systems, which made the complex routers and switches that powered the internet, and confidently project what its earnings would be in 10 or 20 years. The competitive landscape was too fierce, the pace of technological change too rapid. He understood that these were important companies, but he could not translate that importance into a durable, predictable financial forecast. So he put them in the too hard pile. He chose to endure the public ridicule, the underperformance, and the feeling of being left behind, rather than violate his cardinal rule of staying within his circle of competence. A few short months later, the bubble burst. The Nasdaq Composite Index, a proxy for the tech sector, collapsed by nearly 80%. Companies that were once worth billions went bankrupt. The paper fortunes of the new economy gurus evaporated. And Warren Buffett, the man who was out of touch, was left standing with a mountain of cash, ready to buy the ruins of the financial world at bargain prices. His refusal to be seduced by the complexity of the tech narrative was not a failure of imagination. It was his greatest triumph of discipline. The psychological machinery behind our fascination with complexity is powerful and deeply ingrained. One of the primary drivers is the expert halo effect. Our brains use mental shortcuts or heuristics to make judgments, and one of them is to associate complexity with expertise. When a fund manager presents a strategy that involves multi-leg options, quantitative overlays, and algorithmic trading, they sound incredibly intelligent. The sheer impenetrability of their language creates a halo of genius. We assume that someone who can speak this language must possess a deeper understanding of the market. Conversely, the manager who says we buy simple, easy-to-understand businesses with strong brands and hold them forever can sound unsophisticated, almost remedial. We subconsciously penalize the simple message and apply a premium to the complex one, regardless of their respective merits. We equate jargon with intelligence and clarity with a lack of depth. Another powerful force at play is the action bias. This is our innate tendency to feel that we should do something, anything, rather than nothing, especially in situations of ambiguity or perceived opportunity. Complex strategies inherently involve more action, more trading, more rebalancing, more analysis of obscure data points. This constant activity feels productive. It feels like we are working on our portfolio, actively steering it towards success. The simple strategy, the one Buffett espouses, often involves long periods of deliberate inaction. Buying a great business and holding it for decades can feel passive, even lazy. The action bias pushes us away from this patient approach and towards the frantic activity that complex strategies demand. We mistake motion for progress. Compounding this is social proof. When everyone around you is talking about and investing in the latest complex trend, whether it's disruptive tech or a new form of cryptocurrency, the pressure to conform is immense. We think if all these smart people are doing it, it must be the right thing to do. We outsource our judgment to the crowd, and the crowd is almost always chasing complexity. To counteract these powerful biases, you need an applied mental model, a systematic filter to run every new idea through. Let's call it the complexity discount filter. It's a way to turn your brain's natural tendency on its head by training yourself to be skeptical of complexity, not impressed by it. The first step is to actively identify the jargon. Anytime you encounter an investment pitch, an article, or a conversation that is laden with impenetrable acronyms, buzzwords, and technical terms, your alarm bells should ring. Instead of being impressed, you should immediately apply a mental complexity discount. Assume, as your default starting position, that the complexity is there to obscure a weakness. not to articulate a strength. Treat jargon as a red flag, not a green light. The second step is to employ the power of inversion. Instead of asking, "How could this complex strategy make me money?" ask the opposite question. How could this complexity be used to deceive me or hide risk? History is replete with examples. The complex collateralized debt obligations, CDOs, and credit default swaps, CDSs, at the heart of the 2008 financial crisis were designed with a level of mathematical complexity that made them opaque even to the people selling them. This complexity wasn't a feature, it was a bug. It allowed massive, systemic risk to be hidden in plain sight. By actively looking for how complexity could be a weapon against you, you inoculate yourself against its charm. Third, you must consciously apply a simplicity premium. When you come across an idea that is shockingly simple and easy to understand, give it extra weight in your analysis. Actively seek out the businesses and strategies that can be explained on a single page with simple words. Train your mind to see this clarity not as a sign of a low-grade idea, but as a sign of a robust, well-understood one. Finally, use the 5 whys technique, a method developed at Toyota to get to the root cause of a problem. When confronted with a complex claim, ask why at least 5 times. For instance, a pitch might say, "Our company leverages AI-driven synergies to disrupt the logistics space." Your first question, why is that valuable? Because it optimizes delivery routes. Second question, why does that matter? It lowers fuel costs and delivery times. Third question, why is that a competitive advantage? Our algorithm is more efficient than our competitors. Fourth question, why is your algorithm better? It's based on a proprietary deep learning model. Fifth question, why is that model defensible and hard to replicate? If the answers become progressively vague, filled with more jargon, or if they can't answer at all, you've exposed the lack of a simple fundamental truth at the core. The idea goes straight into the too hard pile. The path of the 99%, the antithesis of this approach, is littered with the financial wreckage of those seduced by complexity. This is the realm of the average retail investor who gets lured into financial products that are designed to be sold, not owned. They hear about complex options trading strategies like iron condors or straddles on a YouTube video and, without understanding the non-linear risks involved, they start trading them. They see a, quote, 3x leveraged bull tech ETF and think they've found a magic button to triple their returns, not realizing they can be completely wiped out by a modest market downturn due to the effects of volatility decay. They are playing a game where they don't even know the rules, against professionals who wrote them. The most spectacular historical example of this failure is the story of long-term capital management, the hedge fund that famously blew up in 1998. The firm was not run by amateurs. It was a dream team of financial superstars, including 2 Nobel laureates in economics. Their strategies were the pinnacle of complexity, involving sophisticated arbitrage trades in global bond markets, all amplified with staggering amounts of leverage. Their mathematical models were so advanced that they believed they had essentially eliminated risk. They had built a beautiful, intricate machine for printing money. But their complexity blinded them to a simple, common-sense truth that in a panic, all correlations go to 1. When a financial crisis hit Russia, a seemingly unrelated event, their models broke down. Their carefully diversified positions all started losing money at once. The complexity of their strategy hid the simple, catastrophic risk of its leverage. The fund imploded, losing over $4.5 billion in a matter of weeks, and requiring a bailout organized by the Federal Reserve to prevent it from taking down the entire global financial system. If 2 Nobel Prize winners can be catastrophically wrong by being too smart, what chance does a retail investor have when they venture into similar territory? The direct financial connection between avoiding complexity and building your wealth is immediate and tangible. First, complexity almost always adds hidden costs. Complex investment strategies invariably come with higher fees. The fund manager with the secret algorithm charges a much higher management fee than a simple index fund. Active trading of complex derivatives racks up enormous commission costs and leads to tax inefficiency. These costs are a direct, guaranteed drag on your returns. They are a headwind that you must overcome just to break even. A commitment to simplicity is a commitment to minimizing these friction costs, ensuring that more of your money is working for you, not for your broker or fund manager. Second, and more importantly, complex businesses and strategies contain more unknown unknowns, risks that are impossible to model or predict. A simple business like See's Candies has very few variables that can cause a catastrophic failure. A complex biotechnology company, on the other hand, faces a minefield of risks. A clinical trial could fail, a competitor could develop a better drug, their patent could be challenged, or the FDA could reject their application. Each of these is a potential black swan event that can send the stock to zero. By focusing on simple, predictable businesses, you are fundamentally engaging in a powerful form of risk management. You are reducing the number of ways you can be permanently wrong. This translates directly to lower portfolio volatility and, crucially, a much smaller probability of experiencing the kind of devastating loss that prevents you from ever reaching your financial goals. Simplicity on your balance sheet and in your portfolio strategy is not just an aesthetic choice, it's a mathematical advantage that quietly compounds in your favor year after year. Once you have established the boundaries of your circle of competence and fortified your mind against the allure of complexity, you need a practical mechanism to deal with the constant influx of ideas that lie outside those boundaries. This is where the too hard pile transforms from a concept into an active, operational tool. It is the system for executing the discipline of saying no. This isn't a passive act of ignorance. It's a decisive strategic choice to conserve your most valuable resources, your time, your focus, and your mental energy. Mastering the mechanics of the too hard pile is about building a filter that protects you from distraction and allows you to focus your analytical firepower where it has the highest probability of success. There is no better illustration of the too hard pile in disciplined action than Warren Buffett's long and fascinating relationship with technology, specifically with his close friend Bill Gates. They first met in 1991, and against all odds, the folksy investor from Omaha and the technology visionary from Seattle became the best of friends. For years, Gates would spend hours patiently explaining the intricacies of Microsoft's business to Buffett. He would detail the power of network effects in the Windows operating system, the strategy behind their software licensing model, and the future of personal computing. By any measure, Buffett had the world's greatest tutor on the subject, a direct line to the mind that built the dominant technology company of the era. The opportunity was immense, and the temptation must have been extraordinary. He could see the genius of Gates and the power of his creation. And yet, for the entirety of Microsoft's hyper-growth phase in the 1990s and 2000s, Buffett famously refused to buy a significant stake in the company for Berkshire Hathaway's portfolio. His reason was a masterclass in the disciplined application of the too hard pile. Despite having Bill Gates on speed dial, he fundamentally believed that the technology industry was outside his circle of competence. He felt that the pace of change was simply too fast. He couldn't answer with high confidence what the competitive landscape would look like in 10 or 20 years. Would Microsoft's dominance be usurped by a new technology? He didn't know, and he knew that he didn't know. Therefore, into the too hard pile it went. This story is crucial because it demonstrates that the pile is not for bad companies or bad ideas. Microsoft was, by any objective measure, a phenomenal business. The pile is for any business, no matter how great, that you do not personally understand with the requisite level of certainty. It is the ultimate act of intellectual honesty, a refusal to substitute a friend's expertise for your own. It is the quiet, firm decision to say no, not because the opportunity is flawed, but because your understanding of it is. The psychological demons that the too hard pile is designed to slay are powerful and relentless. The most formidable of these is the fear of missing out, or FOMO. This is the nagging, anxious feeling that others are getting rich from an opportunity that you are passing up. When a stock is soaring and it's all over the news, the psychological pressure to jump on board, regardless of your level of understanding, can be overwhelming. FOMO is an emotion-driven response, not a logical one. It short-circuits our analytical process and pushes us into impulsive action. The too hard pile acts as a cognitive circuit breaker. By having a formal, designated system for these ideas, you create a process that intercepts the emotional panic. When you encounter a hot stock you don't understand, you don't have to engage in a stressful internal debate. You don't have to justify your inaction to yourself or others. You simply follow your process. This belongs in the too hard pile. The act of classification itself is calming. It imposes order on the chaos of market noise. Closely related to this is the challenge of overcoming the endowment effect. This is our tendency to value something more highly, simply because we have invested time or effort into it. An investor might start researching a complex company. They spend a week reading reports and building a spreadsheet. At some point, they realize they are in over their head, but they've already invested 20 hours of work. The endowment effect makes it hard to walk away. They feel compelled to see it through and make an investment, to justify the time spent. This is the sunk cost fallacy in action. The too hard pile is the off-ramp. It gives you permission to abandon the research without feeling like a failure. You aren't giving up. You are correctly categorizing the problem as being outside your mandated area of focus. This act of disciplined abandonment is critical for preserving mental energy and avoiding the decision fatigue that leads to poor choices. You are not rejecting the idea forever. You are simply acknowledging it's not a game you are equipped to play right now. So let's build the blueprint. How do you create and manage your own too hard pile system? It needs to be simple, concrete, and repeatable. The first step is to create the pile itself, either physically or digitally. This might seem trivial, but it's psychologically important. Create a folder on your computer's desktop. Label it "Too Hard," or dedicate a specific folder in a filing cabinet. When an idea comes across your desk, a tip from a friend about a biotech startup, an article about a complex merger arbitrage situation, a new cryptocurrency, your first job is not to analyze it deeply. Your first job is to classify it. To do this efficiently, use the 5-minute rule. Give yourself a strict time limit of 5 minutes to grasp the fundamental business model of the new idea. In those 5 minutes, you must be able to answer 3 questions. 1. How does this company make money? 2. What is its primary product or service? 3. What is its alleged competitive advantage? If you can't get clear, simple answers to those 3 questions in 5 minutes of preliminary research, the inquiry stops. No more time is spent. You drag the file into the digital folder or place the piece of paper into the physical folder. The decision is made. This rule prevents you from getting sucked down rabbit holes of research on low-probability ideas. The third step is to develop your no script. This is a pre-written mental or actual response for when people pitch you ideas. Constantly having to debate and justify your decision to pass on something is exhausting. A simple, repeatable script solves this. It might be, "That sounds interesting, but it's firmly outside my circle of competence, so I'm going to have to pass on it." Or, "My strategy is to focus only on businesses I can easily understand, and that one doesn't fit my criteria." It's polite, firm, and non-negotiable. It protects your time and your psychological capital. Finally, consider a scheduled reevaluation, but with strict rules. Perhaps once a year you spend 1 hour looking through your too hard pile. The goal is not to find something to buy. The goal is to ask a single question. Has the world changed in a way that has made one of these industries simpler and more understandable? For example, an emerging industry might mature over a decade, with clear winners and more stable business models emerging. What was once too hard might now be understandable. This prevents the pile from becoming a permanent black hole, but the long delay between reviews maintains the discipline and prevents you from acting impulsively on ideas you've recently discarded. The antithesis to this disciplined process is the investor who suffers from analysis paralysis. This individual does the exact opposite of the too-hard pile practitioner. When they encounter a complex idea, instead of quickly classifying and discarding it, they become obsessed with trying to understand it. They fall into the trap of believing that with just one more report, one more spreadsheet, one more expert interview, they will finally crack the code. They spend weeks, sometimes months, buried in the minutiae of a business they are fundamentally unequipped to evaluate. They are drowning in data but starved for real insight. They mistake the activity of research for the progress of understanding. The great tragedy here is the opportunity cost. While they are spending 100 hours trying to get to a C+ level of understanding of a complex business, they are missing the 5 A+ opportunities in simple, wonderful businesses that are sitting in plain sight. They waste their most finite and valuable asset, their focused attention, on the lowest probability endeavors. Their portfolio stagnates, not because of bad decisions, but because of an inability to make good decisions in a timely and efficient manner. The direct financial connection of this system is profound, and it centers on the concept of return on intellectual capital. Every investor has a finite amount of time and mental energy to devote to the task of stock picking and portfolio strategy. The too-hard pile is a productivity tool designed to maximize the return on that invested time. By quickly filtering out the vast majority of opportunities that are complex, unpredictable, or outside your expertise, you ensure that 100% of your research time is spent on a pre-qualified list of high-probability ideas. This dramatically increases your hit rate, the percentage of your analyzed ideas that turn into successful investments. Think of it like a baseball player. A great hitter doesn't swing at every pitch. They have a disciplined eye and wait for a pitch in their sweet spot. Pitches that are too high, too low, or too fast are ignored. The too-hard pile is the mechanism that defines your sweet spot. By only swinging at the easy pitches, you dramatically increase your chances of getting a hit. In financial terms, this efficiency leads to a better performing portfolio, built in less time and with less stress. You are allocating your most precious resource, your own brainpower, in the most efficient way possible, a direct and powerful driver of superior long-term financial results and a cornerstone of effective wealth management. There is a powerful and often overlooked connection between the simplicity of a business and the durability of its competitive advantage. The most enduring businesses, the ones that survive and thrive for generations, are often the ones whose core value proposition is disarmingly simple. This simplicity is not a weakness. It is a fortress. An easy-to-understand business model is often more resilient, more predictable, and more resistant to disruption than a complex one. Warren Buffett understood this early on, realizing that the best moats, the term he uses for durable competitive advantages, are often not built on complex patents or proprietary technology, but on the simple, unchanging bedrock of human nature. Recognizing how simplicity itself acts as a moat is the key to identifying the kinds of businesses that can compound your wealth for decades. The quintessential example of this principle is Buffett's landmark investment in the Coca-Cola Company. In the aftermath of the 1987 stock market crash, when fear and panic gripped Wall Street, Buffett saw an extraordinary opportunity. While others were dumping stocks indiscriminately, he began to methodically and aggressively accumulate a massive position in Coca-Cola, ultimately investing over $1 billion, a huge sum for Berkshire Hathaway at the time. His analysis was a masterclass in seeing the simple, powerful truth that was hiding in plain sight. He wasn't building complex discounted cash flow models based on dozens of variables. He was focused on the profound simplicity of the business. What does Coca-Cola do? It sells a non-alcoholic, ready-to-drink beverage. It is, at its core, sugar water in a can, sold under a powerful brand name. Buffett's insight was that this very simplicity was the source of its unbreachable moat. He looked beyond the balance sheet and saw the share of mind that the Coca-Cola brand occupied in the brains of billions of people around the globe. This was an asset that didn't appear in any accounting ledger, but was more valuable than all of the company's factories and bottling plants combined. He understood that the business was not about complex chemical formulas. It was about a simple, consistent taste that evoked feelings of happiness and refreshment. He saw its simple and brilliant distribution model: sell a concentrated syrup to a global network of bottlers who would then do the heavy lifting of mixing, packaging, and delivering the final product. Most importantly, he could see its long-term runway for growth. At the time, per capita consumption of Coke products internationally was a tiny fraction of what it was in the United States. He knew that the basic human desire for a cold, sweet drink was universal. No new technology was going to fundamentally disrupt that. A new computer chip or a faster internet connection doesn't change what people want to drink on a hot day. The business model was crystal clear, the competitive advantage was the brand, and the future was a simple story of global expansion. This simplicity gave him the conviction to make a massive bet during a time of maximum fear, an investment that has since paid Berkshire billions upon billions in dividends and capital gains. The psychological principle that explains why simple businesses are so durable is known as the Lindy effect. The concept, popularized by the author Nassim Nicholas Taleb, suggests a simple rule for estimating the life expectancy of non-perishable things like technologies or ideas. The Lindy effect states that the longer something has been around, the longer it is likely to continue to be around. For example, a Broadway show that has been running for 10 years has a higher statistical probability of being around in another 10 years than a show that just opened last week. This is because it has survived a process of natural selection. It has proven its resilience over time. The same is true for business models. Simple businesses, selling soap, brewing beer, insuring property, selling candy, offering a refreshing beverage, have been around for centuries. Their models are robust because they are tied to basic, unchanging human needs and desires. A company whose business model is based on a complex, cutting-edge technology is, by definition, not Lindy. It has a short history and is vulnerable to being supplanted by the next cutting-edge technology. Furthermore, we are more psychologically equipped to be good owners of simple businesses due to a bias known as mental availability. This heuristic means that we give preference and more weight to things that come to our mind easily. A simple business model is always available in your mind. You can check on it, think about it, and reaffirm your investment thesis without great mental strain. You don't panic and sell your shares in Hershey's because a competitor announces a new, quote, quantum computing enhanced chocolate bar. The threat seems absurd because you understand the simple, emotional foundation of the business. For a complex semiconductor company, however, a competitor's announcement about a new chip architecture could trigger immense fear and uncertainty because you lack the deep knowledge to properly evaluate the threat. This cognitive ease makes it far easier to hold simple businesses through the inevitable ups and downs of the market, allowing you to reap the long-term rewards of ownership without being scared into a bad decision. To turn this insight into a practical mental model for stock picking, you can use the 10-year test for simplicity and durability. This is a simple but powerful framework for evaluating any potential investment. The first step is the forward projection. For any business you are considering, ask yourself this critical question: can I describe, with a high degree of confidence and in some detail, what this business will likely look like in 10 years? For a company like Wrigley's Gum or McCormick Spices, this is a relatively easy exercise. People will still be chewing gum and seasoning their food in a decade. The brands are dominant. The products don't change much. For a social media company or a cutting-edge software firm, this question is much harder to answer. The competitive landscape, the technology, and user preferences can change dramatically in just a few years. If you can't form a clear picture of the business in 10 years, it fails the test. The second step is to identify the key variables. A simple business has very few critical variables that determine its success. For Coca-Cola, you need to track unit case volume and pricing. For a railroad, it's carloads and revenue per carload. The success of a complex technology company might depend on dozens of interlocking variables: the speed of its microchips, the adoption rate of its software platform, its compatibility with other systems, the strength of its patent portfolio, and so on. The fewer the key variables you need to track to understand the health of the business, the simpler and more predictable it is. Third, you must run a disruption scenario. Ask yourself, what could fundamentally disrupt or destroy this business? Then, assess the probability of that disruption. Simple businesses are often incredibly difficult to disrupt. How do you disrupt the fundamental human desire for a bar of chocolate, a can of beer, or a reliable insurance policy? It's much harder than disrupting a specific piece of software with a newer, better version. The moats of simple businesses are often dug into the bedrock of consumer psychology, which is far more stable than the shifting sands of technology. Finally, you can score the business. On a scale of 1 to 10, with 1 being impossibly complex and unpredictable, and 10 being profoundly simple and durable, rate the business you are analyzing. Make it a hard rule for your portfolio strategy. You will only consider investing in the businesses that score an 8, 9, or 10. This simple scoring system forces you to consciously evaluate every idea through the lens of simplicity and durability. The antithesis of this approach is the growth at any price investor who falls in love with narrative stocks. This investor doesn't care about simple, proven business models. They are chasing exciting stories, grand visions of changing the world, often from companies with flimsy, complex, or completely non-existent paths to profitability. We saw this in abundance with the wave of disruptive tech companies that went public in recent years. Their investor presentations were filled with complex charts, impenetrable jargon about synergies and flywheels, and astronomical calculations of their total addressable market. All of this complexity was designed to distract from a simple, ugly truth. The fundamental business model was broken. They were burning through hundreds of millions of dollars in cash with no clear way to ever make a profit. Investors who bought into these complex narratives were not buying a business, they were buying a lottery ticket, and the vast majority of those tickets ended up being worthless. They chose a compelling story over a simple, boring, profitable reality, and they paid the price for it. The direct financial connection between simplicity and a company's financial statements is one of the most beautiful things in investing. Simple, dominant businesses have the best financial characteristics. Because they sell products that people want and have strong brands, they often have significant pricing power. This translates directly into high and stable gross margins on the income statement. You can see this clearly in the financials of companies like Coca-Cola or See's Candies. They don't have to constantly compete on price. Furthermore, these businesses often require very little capital expenditure to grow. A brand, once established, is a self-sustaining asset. This means they generate enormous amounts of free cash flow and exhibit very high returns on invested capital, ROIC, a key metric of a wonderful business. When you learn to look for a simple business model, you will find that it leaves a distinct and beautiful fingerprint all over the financial statements: wide margins, low debt, consistent cash generation, and high returns on capital. This is the financial engine of long-term compounding. Simplicity is not just a philosophical preference. It is a direct indicator of financial quality and the bedrock of a successful, stress-free investing journey toward wealth management and true financial freedom. We have arrived at the final and most transformative stage of our journey. We've explored the foundation of the circle of competence, dissected the dangerous allure of complexity, detailed the mechanics of the too hard pile, and understood how simplicity itself forms a competitive moat. Now we must synthesize these pillars and understand their ultimate payoff. This is not about a single good decision or one successful investment. It's about the cumulative effect of a lifetime of clear, simple, and rational choices. This is the compounding of clarity, how a steadfast commitment to simplicity transforms not only your portfolio but your entire financial life, leading to a state of prosperity and peace of mind that the 99% who chase complexity can never attain. This is the realization of the final promise. To see this principle in its ultimate form, we need only to look at the character of the Berkshire Hathaway investment portfolio, viewed not as a snapshot in time, but as a long-form narrative written over 6 decades. If you study the collection of businesses that form the heart of this empire, you are struck by their overwhelming, almost mundane simplicity. The engine room of Berkshire is insurance. Geico, National Indemnity, General Re. The business model of insurance is centuries old. Collect premiums up front, the float, and pay out claims later, hopefully investing the float profitably in the interim. It's a business of probabilities and common sense. Look at its major equity holdings. American Express, a simple business of lending and transaction fees built on a powerful brand of trust and aspiration. Bank of America, engaged in the age-old business of taking deposits and making loans. The BNSF Railway, a massive but fundamentally simple business of moving goods from point A to point B. Berkshire Hathaway Energy, a utility company that generates and sells electricity, a basic need of modern life. And, of course, the portfolio is filled with the consumer brands we've discussed: Coca-Cola, See's Candies, Dairy Queen, Duracell. The story of Berkshire Hathaway's success is the conspicuous absence of a single Hail Mary bet on a complex, unproven technology. It is the story of the relentless, repetitive application of a single, simple filter. One by one, over decades, Buffett and Munger made clear, understandable decisions to buy businesses they could hold forever. Each individual decision was a brick, but laid consistently, one on top of the other, year after year, they built one of the largest and most successful corporations in human history. The compounding was not just in the money, it was in the clarity of the process itself. The empire was built not by a series of brilliant, complex insights, but by the avoidance of a single, stupid, complicated mistake, repeated ad infinitum. This is the grand testament to the power of a simple philosophy, patiently applied over a human lifetime. The underlying psychological principle that makes this long-term strategy so effective and sustainable is the management of our finite cognitive resources. Specifically, a simplicity-based approach leads to a state of cognitive ease and a dramatic reduction in decision fatigue. Daniel Kahneman, the Nobel laureate psychologist, describes our thinking as being governed by two systems. System 2 is our slow, deliberate, analytical brain. It's what we use to solve complex math problems. It is powerful but easily depleted. System 1 is our fast, intuitive, automatic brain. It operates with very little effort. Cognitive ease is a state where System 1 is in charge. Things feel familiar, effortless, and good. When you operate within your circle of competence, you are primarily living in a state of cognitive ease. The businesses are familiar, the variables are few, and the decisions feel natural. Conversely, trying to analyze a complex business outside your circle requires the constant, draining effort of System 2. This leads to decision fatigue, a well-documented psychological phenomenon where the quality of your decisions deteriorates after a long session of decision-making. An investor who is constantly grappling with complex, hard-to-understand investments is burning through their limited supply of high-quality mental energy. They are perpetually exhausted, stressed, and prone to making mistakes, especially late in the day or during periods of market turmoil. Their investing life is a source of chronic anxiety. The investor who adheres to simplicity, however, conserves their precious mental energy. Their decisions are less frequent but of higher quality. Their process is calm and repeatable. They are not fatigued by the market. They are energized by the clarity of their strategy. This psychological sustainability is a massive hidden advantage. It allows you to stay the course for the decades required for compounding to work its magic. This is the very definition of stress-free investing. To operationalize this long-term vision, the final applied mental model is to create your own investment policy statement for a simple life. This is not a complex legal document. It is a one-page manifesto that will serve as your constitution, your North Star, during the inevitable storms of the market. The first step is to write your mission statement. It should be a simple declaration of your core philosophy. Start with a sentence like this: "My investment strategy is built on the foundation of simplicity and understanding. I will only invest in what I can easily explain, and I will prioritize the preservation of my capital and my peace of mind." Second, define your never list. Be explicit. Based on your circle of competence, list the categories of investments you will never touch, no matter how tempting they become. Your list might include: I will never invest in leveraged ETFs. I will never buy stocks of biotech startups pre-revenue. I will never speculate on currencies or commodities. I will never invest in a company whose annual report I cannot read and understand. This list is your pre-commitment to discipline. It's the wall you build around your portfolio to protect it from your own worst impulses. Third, establish your simple, repeatable process. Detail the steps you will take for every potential investment. For example, 1. I will only research companies from my pre-approved list of industries. 2. Every new idea must first pass the 5-minute rule before any further work is done. 3. Every company that passes must then be subjected to the 10-year test for durability. 4. I will only purchase a stock when I can buy it at a significant discount to my conservative estimate of its intrinsic value. This written process removes ambiguity and emotion from your decision-making. Finally, and perhaps most importantly, schedule a do-nothing review. Put it on your calendar, perhaps quarterly. The explicit goal of this review is not to find something to buy or sell. The goal is to review your current holdings and reaffirm your original simple investment thesis for each. Ask yourself, has the simple story for this business changed? In most cases, for the types of businesses you will own, the answer will be no. This practice institutionalizes patience. It trains you to think like an owner, not a trader, and reinforces the idea that your default action should be to do nothing at all. The antithesis to this life of compounding clarity is the sad story of the strategy-hopping investor. This person is in a perpetual state of financial confusion. They have no core philosophy. They try value investing for 6 months, but when it underperforms the market, they get impatient. They watch a video about day trading and decide that's the secret. They lose money, then they hear about crypto and pour their remaining capital into that. When that crashes, they get an email about a guaranteed options trading system. They are constantly chasing the next secret, the next complex shortcut to wealth. Because they never commit to a simple, understandable philosophy, their portfolio is a chaotic mess of past mistakes. They are constantly churning their account, racking up enormous fees and taxes, and making one emotionally driven error after another. Their financial life is a source of constant stress, and they are slaves to the noise of the market. They never achieve the calm, quiet compounding that builds real wealth because they are always tearing up the garden to see if the seeds are growing. The direct financial transformation that results from a lifelong commitment to simplicity is staggering, and it comes from 2 primary sources. First, and most defensively, it is the powerful, almost absolute avoidance of the zero. A single catastrophic loss, a single investment in a complex, misunderstood business that goes bankrupt, can be mathematically devastating. If you lose 50% of your capital, you need to make a 100% return just to get back to even. It can set your goal of financial freedom back by a decade or more. The discipline of simplicity is the most effective risk management tool ever devised because it keeps you far away from the kinds of situations that are prone to blowing up. Second, and most offensively, is the unhindered, untaxed, and uninterrupted power of compounding. By investing in simple, durable, cash-generating businesses and holding them for the long term, you are harnessing the most powerful force in the financial universe. Because you trade less, you pay far less in capital gains taxes and commissions. This is not a small detail. It is a direct mathematical accelerator of your wealth. A few percentage points of return that are not lost to friction costs each year compound into a massive difference over an investing lifetime. Your portfolio is transformed from a source of stress and anxiety into a calm, predictable, and ever-growing engine of prosperity. This is the final promise fulfilled. It is the moment where your wealth management strategy aligns with your life, delivering not just financial returns, but the invaluable dividends of clarity, confidence, and peace of mind. You have made it to the end of this journey, and the knowledge you now possess is a powerful tool. You have not just learned a tactic, you have absorbed a complete philosophy. You understand that the rejection of complexity is not a shortcut, but a deep, strategic choice. You now have the mental models, the circle of competence, the complexity discount, the 10-year test, the too-hard pile, to build a financial life of clarity and conviction. This is a rare and valuable arsenal that separates the master from the amateur. You have invested your time, and in return, you have acquired a framework that can protect and grow your wealth for the rest of your life. But it is crucial to understand that Warren Buffett's system is not a single pillar. It is an interconnected latticework of mental models. The principle of simplicity you've mastered today is the foundation, the very ground on which everything else is built. But it is connected to other, equally powerful concepts: how to value a business, how to think about market fluctuations, how to cultivate the right temperament. The tool you've just acquired is like a powerful lens, but to complete the telescope, you need the other pieces that allow you to aim it correctly. Mastering one principle in isolation is powerful. Mastering how they connect is transformative. The video that is now appearing on your screen is not an accident. The algorithm has identified it as the next logical step in your journey. Think of what you've just learned as one piece of a map. That video is the next piece. It is the link that connects the principle of simplicity to the next critical component of the system. It holds the answer to the question that naturally follows. Now that I know what kind of business to look for, how do I know what price to pay for it? That is the bridge from philosophy to action, from defense to offense. So the choice before you is not simply whether to watch another video. It is a declaration of intents. Are you a tourist in the world of financial education, content to collect a few interesting souvenirs? Or are you committed to the ascent, dedicated to building the complete mental arsenal required for true financial sovereignty? The path of the 99% is to stop here, satisfied with this single insight. The path of the serious investor, the future entrepreneur, the person truly committed to financial freedom, is to continue the journey, to forge the next link in the chain. The knowledge is waiting. The choice is yours. Complete the map.